Hello, and welcome back to another lecture portion of Chapter 16. And remember, Chapter 16 is talking about investments, right? A corporation using excess cash to buy, to invest rather in another corporation, whether it be through debt or through stock. Now, in the prior video, we looked at debt investments. We saw how to record debt investments. Very straightforward, nothing too difficult about it, right? Well, in this video, we're going to look at stock investments, and we're going to see how exactly does a company invest in another corporation's stock, right? So stock investments are investments in the capital stock of another corporation, okay? So we're not talking about let's say we're Acme Corporation, right? We're not talking about Acme Corporation stock here. We're talking about Acme using excess cash to buy stock in Beta Company, to invest stock in Alpha Company, to invest stock in Zeta Company, right? They're buying stock of different companies. Now, the accounting for stock investment does differ, and it depends on the degree of influence the investor has over the issuing corporation. What in the world does that mean, right? How could buying a stock allow anybody to influence the issuing corporation? Well, remember, when we're talking about stock, stock has voting rights, right? So, in essence, I could buy a bunch of company stock, specifically 51%, and I could run the board of directors, right? I have the majority of shares outstanding. I have a lot more votes than everybody else. So I can impart my will on that company, right? Same thing with corporations, right? Corporations are investing in stock, so that's why it depends how we record it, right? And it's based on that influence. How much influence does a corporation have over another corporation through the means of buying stock? Okay. Now, the presumed influence that a company has is based on the investor's ownership interest. So we're going to have some accounting guidelines that we need to work with, right? So if we own anywhere from 0 to 20% of another another corporation's outstanding stock, we have no real significant influence. So how do we account for that? Well, we record the investment using the cost method. Okay, we'll go through an example of each of these, but for right now, you just need to know what ownership percentage dictates how do I record these, right? 0 to 20%, we're going to use a cost method. If we own anywhere from 20 to 50% of a corporation's stock, the presumed influence that we have on that investee is significant, okay? And in that case, we need to use the equity method. Now, what if we have 50% to 100% of the company's outstanding stock? Well, in that case, if we own more than 50%, we say that the company that owns 50% of or more of that other company's stock, that investee, that corporation that invests in the other corporation, their presumed influence on that investee is controlling. They actually control that company, okay? How do we report it? Well, we have to do consolidated financial statements, okay? So when we're talking about consolidating financial statements, basically what we're doing is, or an example of this type of ownership or situations that will need consolidations, usually that's like a parent and a sister company, okay? So the investment valued on our books or the parent's books, we're going to use cost or equity method, okay? The investment is eliminated whenever we consolidate our financial statements. And I'll show you what that means here in a second. Again, what's the takeaway here? The key takeaway is knowing that the accounting record keeping depends on the extent of the investor's influence over the operating and the financial firms or financial affairs, of the issuing corporation. That issuing corporation is the investee, right? We are the investor, they are the investee. So as long as you know which method goes based on which percentage of ownership, you're fine. I would put this on a note card if I were you. If you didn't write it down, you have the PowerPoints, go back, jot it in your notes, study it. You got to know that, okay? And again, we'll go through a bunch of examples from the book that will really help you out with this, okay? So if we hold less than 20%, right? Again, we're going to use the cost method, okay? We're going to use the cost method. The investment in that investment is going to be recorded at the cost, and the revenue that is recognized, okay? Only when cash dividends are received, right? So what in the world does that mean? Well, just like with bonds, we had interest, periodic interest payments. Well, with this, we're going to have periodic dividend payments, right? So what we're saying is the investment is recorded at cost and revenue is going to be recognized when those cash dividends come in, okay? Excuse me. Costs include, again, all the expenditures that are necessary for us to buy these investments, right? Price plus commission or brokerage fees, if any exist, okay? Think about it this way, right? And you notice on a slide to give us a nice little helpful hint that says the entries for investment in common stock also apply to investments in preferred stock. So we as a corporation, we could buy preferred stock of another company, right? Yeah, we could do that. The only catch is, guess what? Preferred stock doesn't have voting rights, right? So we really don't need to worry about actually, yes, we do. I apologize. We do need to worry about the stock, how we record it, okay? So if you're kind of curious what the cost method is, the cost method basically says that we're going to record the investment at cost, and the revenue is going to be recognized when? Only when cash dividends are received, okay? And again, we use the cost method when we're holding less than 20%, okay? So let's look at a quick example here of how do we record acquisition of a stock investment. Again, the key here is we have less than 20%, okay? So at acquisition, the stock investment, again, is going to be recorded at cost. What do we do? Well, we need to debit stock investment and we need to credit cash, okay? I'd put that in your notes, study it, because it's never going to change. I don't care what entry we do, as long as we hold less than 20%, we're going to debit stock investment account for the cost, and we're going to credit cash, right? So look at the illustration here. They tell us that on July 1st, 2017, Sanchez Corporation acquires 1,000 shares. That's 10% ownership of Bill Corporation common stock. Sanchez pays $40 per share, right? The entry for the purchase is debit stock investments, 1,000, because we're buying 1,000 shares times that market price of $40 per share. We debit it for $40,000. We also credit cash for $40,000 as well, okay? What do we do when dividends are received, right? Well, when dividends are received, all we need to do is debit cash and credit dividend revenue, okay? If you don't have that in your notes, put it in your notes because you need to memorize that. Hey, I hold less than 20% of a stock. What's the journal entry? Right off the bat, you need to know debit cash, credit, dividend revenues. Now, let's see, how do we calculate that, right? Well, they tell us that during the time Sanchez owns the stock, it makes entries for cash dividends received. Yeah, that makes sense. That's what they're supposed to do, right? Now, what if Sanchez receives a $2 per share dividend on December 31st? That's easy. Debit cash for $2,000, 1,000 times the $2 per share dividend, and then we credit dividend revenue. Okay? When we sell stock, what do? Well, we got to debit cash, and we need to credit stock investment, and then we need to compare the difference, right, from the cash that we received versus our investment in the stock. There may be a gain or loss, so we have to calculate that gain or loss. Again, that gain or loss, it's reported under other expenses and losses, or it's reported under other revenues and gains in the income statement, okay? So now we're going back to that idea of what's this other comprehensive income, right? Well, part of that ends up being gain or loss, other expenses and losses. We incur a loss or expense that's not directly tied to our core operation, right? It's peripheral, right? We're just investing we want some extra cash, or we have extra cash, so we want to generate some earnings here, or we might have a strategic motives here, right? So the point is, the takeaway here really is knowing how to debit, or what to debit, what to credit, how to calculate that gain or loss, and then knowing that, again, that gain or loss, if we have a loss, it's going to be reported as other expenses and losses. If we have a gain, it's going to be reported as other revenues and gains within the income statement, okay? So looking at the example here, it says that we received net proceeds of $39,000 on the sale of its Bill stock. On February 10th, 2018, because the stock cost $40,000, Sanchez incurs a loss of $1,000. Here's what we do to record it. Since we have a loss, we need to first debit cash, because we're receiving cash of $39,000. We need to credit stock investment, $40,000. And then we can look and see, well, wait a minute, debits and credits don't equal. I got less cash than what the stock was, or what the value of my stock investment was, so I have a loss. $1,000 has to be debited to loss on sale of stock. Now, what happens if we hold between 20% and 50%, right? Well, remember, when the investor owns, again, between 20 and 50% of the common stock of a corporation, it's generally presumed that the investor does have a significant influence over the financial and operational activities of the investee. So we got to use the equity method, okay? Now, under the equity method, the investor does not record its shares of the investee's income until the investee has earned income, okay? So, at acquisition, what do? Well, at acquisition, the investor records the investment at cost. Okay. The investment is debited, or stock investment account is debited, and cash is credited, right? Each year, the investor records its share of the investee's income, right? So let's say that investee's income is X% of ownership in the investee. What do? Well, we debit stock investment, so we're increasing the value of that stock investment, and then we're crediting revenue from stock investment, right? What if we have a loss? What if there's a loss? Well, if there's a loss, the investee, or we just do the opposite entry, right? That's all. So the key takeaway here is knowing that when we use the equity method, we are actually recording a proportionate share of the earnings or the losses, okay? We also record dividends. Now, how do we record dividends? Well, again, if we own between 20 to 50%, we say we have significant influence. The investee pays the investor a dividend. We basically debit cash and then we credit stock investment. So the key here is, since we're using the equity method, we do not credit any revenue accounts per se, right? Anytime we receive revenue through dividends, or anytime we receive, the company reports earnings, we hit that investment stock account or stock investment account, okay? Let's look at an example here, okay? So let's say that Miller Corporation acquires 30% of common shares of Beck Company for $120,000, okay? For 2017, Beck reports net income of $100,000 and pays dividends of $40,000. We have to prepare the journal entries. So, because we have significant influence, we're going to use the cost and the equity method, right? The cost method just says book it at the cost you acquire it for. Okay. So, we bought $120,000 of Beck Company stock. We're going to debit stock investments for $120,000. We're going to credit cash for $120,000. Okay. Now, the end of the year rolls around, right? We have significant influence because we're holding between 20 and 50%. We need to record under the equity method the proportion of the investee's net income. So they tell us that Beck reported net income of $100,000. We need to report that or we need to take that net income and we need to recognize that as an increase in our stock investment. So the equity method says we debit stock investments for 30% of our ownership within Beck Company. They made $100,000, so we multiply that by 30%. We increase our stock investment by $30,000. What do we credit? Well, we need to credit revenues from stock investment, $30,000, okay? December 31st, they also paid dividends throughout the year, right? And the total ends up being, we'll say $12,000, right? Well, we're getting cash, basically $40,000. We're getting 30% of that total dividend that they paid. 40,000 times 30% gives us a $12,000. Then we need to increase our investment in the stock. So we credit stock investment $12,000 to show that they paid us cash, so our ownership or the value of our ownership is impacted and it goes down, okay? So to look at this a little deeper, right? Look at the stock investment account, right? We need to post the transactions, right? Once we do the journal entry, we have to post them, okay? So once we post the transactions for the year, right, we need to look, well, what's the revenue in the investment accounts, right? Well, think about it. We already did the journal entries. We went through each step. Now we just have to post them, right? The revenue from stock investments goes up by $30,000 because that's 30% of their net income. But look at the stock investment, right? On January 1st, we invested $120,000. We took 30% of their net income, or recognized 30% of their net income. But we also received dividends, right? And so we had to credit those dividends. So what's the value of that stock investment now in Beck Company? It's $138,000. We started off with 20, right? We took some of their 30% of their net income, but that dividend that they paid has to decrease, right? It's going to decrease our ownership in that company. So the ending balance then is $138,000. Okay? So remember, under the equity method, the investor records dividends received by crediting what? Stock investment. So that's key, right? Let's go back here for a second here, because I just want to break it down for you. What's the difference between the cost method and the equity method? Well, in the cost method, we don't claim or we don't book a percentage of that company's net income. That's number one. Cost method, we don't do it. Equity method, we do it. When we get dividends, under the cost method, we recognize dividend revenue, right? Under the equity method, we don't recognize dividend revenue. We recognize a decrease in the stock investment account, okay? Very important. Now, when we're looking at when we have controlling interest, right? What is controlling interest? Well, that means that we hold more than 50% of a company's common stock, okay? That investor or that corporation that holds 50% of another firm's common stock is known as the parent company, okay? So the entity whose stock is owned by the parent company, they're known as the subsidiary or an affiliate company, okay? So let's say we have Coke and Pepsi, okay? Let's say that Pepsi decides to purchase more than 50% of Coca-Cola's outstanding stock. Guess what? They are now affiliated. Why? Pepsi has purchased 50% or more than 50% of of Coca-Cola. Pepsi has significant influence. In fact, they have controlling influence over the financials and the operations of Coca-Cola. Coca-Cola is now a subsidiary or affiliate of Pepsi Company. Okay? So, how do we record this? We're going to consolidate the financial statements, really. Okay? What we have to do, or what Pepsi would have to do, since they are the parent company, okay? The investment in that subsidiary or the investment in Coca-Cola on Pepsi's books is going to be booked as a long-term investment, and we're going to prepare consolidated financial statements, okay? Consolidated financial statements present the assets and the liabilities that are controlled by the parent company and the aggregate profitability of the subsidiary company. So basically what we're doing is we're taking both sets of financial statements, putting them together, okay? So again, some examples and kind of like the magnitude of corporations that purchase 50% of somebody else's stock, right? So look at PepsiCo. Who's PepsiCo own? Well, they own PepsiCo. They own Frito-Lay. They own Tropicana. They own Quaker Oats. They own Gatorade, right? So what happened? Well, PepsiCo just went out on a market and said, I'm buying 50% or more of your shares, okay? Same thing with the Disney company. What do they own? Well, they own Capital Cities. They own ABC Incorporated. Obviously, they own Disneyland and Disney World. Apparently, they own the Mighty Ducks hockey team. They own Anaheim Angels, and they own ESPN. Okay? So we're going to do some examples of how this works through the books. But it's kind of interesting because look at Procter & Gamble. They acquired Gillette Company for $53.4 billion, right? So what happened was the common shareholders of Procter & Gamble elected the board of directors of Procter & Gamble, right? And what happened was that Procter & Gamble's board of directors controls the property owned by the corporation, which includes the common stock of Gillette, right? So think back to when we talked about common stock, we'd said that, hey, there's the board of directors, right? The board of directors answer to the shareholders. So the board of directors select the officers, they select the managers of the company, right? So if I own 50% of Procter & Gamble's stock, guess what I'm doing? I'm telling them to, since I have all that stock, they own Gillette, right? So basically one company can run 3 or 4 different companies, right? So let's look at it this, and as we go through it, hopefully it'll become a little bit more clear, right? So let's look at the Procter & Gamble board of directors, right? They control the property owned by the corporation, right? That includes common stock of Gillette. So they're in a position to elect the board of directors of Gillette. Basically, they control Gillette's operations, okay? So if you look at the example here, Procter & Gamble company, right? That's like a single entity. And underneath that single entity, there's a bunch of other controlling groups and separate legal entities, right? So Procter & Gamble company board of directors, they control the Procter & Gamble company. That makes sense, right? Because the board of directors of one company controls that company's, assets, liabilities, all that stuff, right? But because Procter & Gamble company bought 50% of Gillette, that means that the Procter & Gamble board of directors then elects the Gillette company board of directors. Gillette company board of directors controls Gillette company's assets, liabilities, picks their managers, elects picks their officers and all that stuff. So we could see now that if you have the money, you can control a lot of stuff, right? Don't worry about the do it investments for this, because we're gonna run through a number of examples of how to do that. Okay, so tune back in for our demo video where we run through the cost method, the equity method, and the controlling method.